Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, November 5th, 2022. It's been another great week of shows with great guests and, of course, great topics. And we kicked off the week with a look at reconnecting defined benefit and defined contribution plan investment structures. Let's take a look.
If you look at the savings program, that's our defined contribution effort, our defined contribution product at the University of California. We serve over 320,000 participants in our 10 campuses, 5 medical centers. And it was really created, the savings program was created over 50 years ago to initially be a purely supplemental savings vehicle for participants or employees to save above and beyond their mandatory pension contributions. Today, over $30 billion in assets have been amassed in our 403B, 457, and our DCP, a 401A plan. Most of those assets, as I said, are actually still voluntary. However, really important to point out, and this is, I think, where we're going to have an interesting discussion and why we're thinking about alternatives in the DC space, is in 2016, new hires have now the option, or since 2016, have now the option to choose a 401k-like primary retirement benefit. No access to the pension, contribution to a defined contribution plan, only 7% mandatory savings rate on the employee, and the 8% met on our employer side. So increasingly, we have a subset in our DC plan that do not have access to guaranteed income, do not have access to a pension anymore. And we're starting to look and feel a little bit more like many other corporate plans in the US, where we have over 20,000 individuals today that truly have a 401k-like benefit only. And therefore, that obviously has a ramification when it comes to thinking about longevity risk, hedging longevity risk, thinking about asset allocation and inclusion of asset classes. But hopefully that gives you a little bit of an idea of the plan that we're managing. About 30 billion, 320,000. Maybe if we can start with the definition, because I agree this is really important. Historically, especially in the defined contribution space, you heard DC plan sponsors talk about alternatives, about REITs, commodities, tips. Those, in my view, are not alternatives. At best, you can call them alternative 1.0, but you rightfully pointed out what we really should be talking about is private real estate, private equity, absolute return strategies. And I think the UC is the poster child of that philosophical disconnect between how a pension invests and how a defined contribution plan, or for the vast majority of DC plans, how they invest assets for participants today or offer solutions for investors to invest their assets. Marco, as a participant of UCRP, that's our pension, has a 30% implicit allocation to alternatives, 12% private equity, 7% private real estate, some absolute return strategies, some real assets. Same individual, Marco now looks at his DC lineup and the offerings that we offer under the hood of the target date fund, for example, no allocation to alternatives in a traditional sense whatsoever. Currently, our target date fund, we have over $14 billion in Pathway, our target date fund today, no alternative exposure. So we at the UC are a prime example of that philosophical disconnect that for a pension, it is good and it is important to have alternative assets. Yet the DC plan that we offer for our participants today is absent or is not offering any of those asset classes that are really important from a diversification and an expected return perspective. So the UC is a prime example why there's a philosophical disconnect in the US today. When you talk to plan sponsors, and we're in a similar boat, you will usually hear 3 reasons why it's on the defined contribution side more difficult or more challenging or more risky. Number 1 is fiduciary risk. Often we're not subject to ERISA. Many, of course, 401k plans are subject to ERISA. So fiduciary risk, the risk or the fear of getting sued for incorporating alternatives is always first and foremost being mentioned when you talk about the hesitancy around incorporating alternatives. Fees is another one. And that's true for the UC as well, have been a victim of our own success. I have, over the last 5 years, touted the reduction of our fees in our DC plan. We were able to reduce it by almost 70% over the last 5 years. So we've created that mindset in our governing structure, in our governing board, that low fees are a good thing. And of course, now trying to explain why alternatives with a much, much higher management fee an administrative cost or a good thing is now, in a way, going against that very argument that we've been making, that reducing fees and being cost effective is a good thing. So fees is the second very important, often brought up topic around why we might not want to do that. And then the third and final one is operational aspects. Usually what you hear is daily valuation. These funds or these structures are not daily valued or often not daily valued. There's liquidity constraints with these products, and that's why a daily valued defined contribution setting is not the right space. All of those reasons, in my view, in our view, are increasingly a convenient way to not have to talk about alternatives. And indeed, in many instances, there are solutions and ways to actually mitigate all those three main reasons and hesitancies why alternatives are not in the core lineup, certainly not under the target date fund asset allocation hood today.
Next up, we discussed creating a financial foundation for the future. Let's take a look.
You know, Jeff, that's such an interesting question because there are multiple answers to that question. And the interesting thing about the answers are they probably hit every single person that you talk to and every single person in America. And these folks are different. Some of them have a lot of money, right? Those folks, they may say, hey, well, financial literacy is important to me because I have a kid who I don't want to stay on my couch forever. I want my kids to be financially independent. I've worked very hard throughout my entire life to give them some sense of generational wealth or some portion of generational wealth. But generational wealth without generational knowledge doesn't exist. Because 90% of wealthy families lose their wealth by the third generation. 78% of wealthy parents say they don't trust their kids with an inheritance. And so for those families, it really is about how they can create a legacy, and they can't create that legacy without giving their kids financial education. So that's on one end of the spectrum.
Yeah. Go ahead. I'm sorry.
No, but really quickly, on the other end of the spectrum, there are people who are wealth seeking. And for them, financial education is truly the key to unlocking a different life for their families. When you think about people who are just the average person in America, 40% of every American can't scrape together $400 in the case of an emergency, right? If I ask them what's an emergency fund and how much do you need in an emergency fund, I guarantee you a significant percentage of them probably couldn't answer that question either. And so having financial education for those folks who want to have a different life for themselves and for their kids is critical so they even know where to start. You know, it's really interesting that in America, we talk about the democratization of investing. And there are companies like Robinhood that have truly, in many ways, quote unquote, democratized investing because, 20 years ago, if you asked the person, would you like to invest? They would say, yes, but I don't really know how. I don't have a financial advisor. I'm not connected with anyone on Wall Street. I don't know how to do that. Now, if you ask the average person, do you know how you can invest? The average person would probably say, yeah, I can go to a website like Robinhood, or I can go to, an online provider to enable me to do that. But they still don't know what they're doing, and they still don't know how to do it. So to your point, at this time when the economic uncertainty is closing in on all sides of us, the last thing you need is someone who has the capability of investing, but doesn't have the knowledge for how to do so. Because they're going to put all of their eggs into like, hey, I heard my friend at work talking about Amazon I should buy Amazon now. Amazon's low, so I put all of my money in Amazon. And then they lose that money and they're in worse shape than they were before. And that really is where we are as a nation. We have the democratization of this access, but we don't have the democratization of knowledge, and that's going to lead people to a really bad place. Listen, that's okay. You can't get it out, but for the past 50 years, we've been trying to get financial education into school systems, and that hasn't been working. And the reason that hasn't been working is primarily because we have a lot of people who are interested in and invested in getting this education to kids, but those people don't necessarily know how to engage and excite kids. They're two completely different worlds. When's the last time you walked into, your local bank or talked to your local banker and they made financial education fun? They don't. I mean, they're great at what they do for a reason. They're bankers. They're not teachers. They're not entertainers. So what we're doing at Goal Setter is, my background is that I come from Nickelodeon and Discovery Education and ESPN. So I have a really strong background in education meets entertainment meets gamification. And we are bringing key financial concepts into high schools across America, middle schools across America, and even elementary schools by making them fun. So we have videos that are TikTok-like videos. They are written by comedy writers. They are informed by financial educators and financial professionals. But we know that in order to make this whole notion of finance fun, we've got to bring it to kids in a way that they want to see it. And this is the TikTok generation. They don't want to watch, a 50-minute video. They don't want to hear an hour-long lecture. They're like, give it to me in 5 minutes or less, preferably 3 minutes or less. Make it fun, make it entertaining, and then let's move on to the next topic. Thank you.
Well, we're halfway through the best segments of the week. When we come back, we'll take a look at the other half. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Next up, we discussed real estate predictions for the remainder of 2022. Let's take a look.
Yeah, there are a couple. You and I looked at a USB report that you sent me that I think is pretty interesting and talks about the California problem, about San Francisco and Los Angeles potentially being overvalued. Another area I'm looking at, of course, is Austin, Texas, just because it's grown so much during the pandemic. I'm also looking at Phoenix, Arizona. That's another place where, that was at the top of the Case-Shiller price index for about a year as prices just kept going up, but they may be overbuilding there. So I think there are a bunch of places to be looking at right now in the US and of course internationally. You know, as you said earlier, they're not strictly correlated, but they definitely move with each other sometimes. How high can we get? I think seems to be the question everybody's asking. I don't see it going too much higher. Maybe we hit 8, but I think that we're going to see it scale back over the next year, hopefully, to a more reasonable rate. I don't think we're going back to 3% anytime soon, but I think a 5 to 6% over the next year seems pretty reasonable. It definitely depends. I think we're going to see some good news on the rental front. One of the things that that happened during the pandemic is we saw a sort of slowdown in building, right? We had supply chain issues, things like that. There's going to be a lot of supply coming on the market in especially those major metros. So that should be good news. I think we're probably going to see rent start to stabilize. It's not going to drop big anytime soon, but it's definitely going to stabilize. So that should be some relief. I mean, as far as renting versus buying, it's so market specific and really it's also sort of your life specific depending on where you're at and if you think you're going to stay somewhere a long time. If you don't think you're going to stay somewhere for 5 years, it may not be time to buy. No, it's not. And, you know, it's funny. There have been a couple of startups to try to figure out how to kind of hack moving. There's a couple of them that where you can sort of rent your furniture and get, you know, a whole new set of furniture. But really, there's nothing that really makes moving much easier. And I think that's one of the reasons that people tend to stay longer in their houses. It's another reason that people want to rent single family rentals. One of the reasons that they have boomed is that people want a house sometimes, even if they can't afford to buy one. It's very sector specific. So industrial has been really hot, but then we've seen companies like Amazon pulling back on you know how much warehouses they need. I still like industrial as an investment. Office, we've talked about before, it's pretty iffy right now. I still like grocery anchored retail or like the sort of essential retail. I think is a really safe place to be. Yeah, I'm watching layoffs a lot, and and we are seeing a lot of layoffs in tech, and they're not over yet. So, yeah, Facebook has they gave back some leased space in New York. We've seen other companies do that. Salesforce is leasing out part of their building in San Francisco. You're seeing a lot of subleases, which is a sign that companies are thinking differently about. Maybe they made a commitment for 5 to 10 years. They decide they don't need that space. They're going to try to sublease it out. You know, it's really challenging. WeWork has gotten out of a couple of leases in California. There's a lot of shifting happening on the office front because companies don't seem to know right now how many employees they need and or how many employees they need to cut in order to maintain their budgets. I think it depends on how long it is. That's one of the things that we're, as we watch these numbers and we start to hear about recessions, I think mostly a lot of people, even the Jamie Dimons, are predicting a short sharp. A short sharp won't disrupt real estate too much if it's just a recession where we have, you know, a couple of cycles of you know, lower economic growth. That's fine. If it's a prolonged one, which I don't think we're going to get, that could be a little more concerning. But overall, yeah, we're going through an office reset. It started during the pandemic. It is still shifting. I think one of the things that we are seeing, though, is a lot of companies that are concerned about profitability. They may have fewer employees, but they want those employees in the office more. And the sort of the balance of power has shifted back to the employer, which means if they say you need to be in the office, then you're probably going to want to be in the office.
And finally, we dispelled misconceptions around 529 college savings plans. Let's take a look.
There are a lot of questions around 529 savings plans, and sometimes people do think that, you know, they can't invest in a 529. And literally, 529s have been set up to be so extremely flexible that anyone can invest in a 529 account. So it could be the parent of a child that they're saving for higher education. It could be a grandparent. In my case, I'm an aunt and I save for my niece and my 2 nephews. So it could be aunts, uncles, friends. You could save for your loved ones if they're good friends of yours and you don't have children of your own, or even if you have children of your own, you can still save for anyone. We do have people also opening accounts for themselves. And so given the economy that we're in currently, there are a lot of adult learners going back to further their education. They can open an account for themselves and also name themselves a beneficiary and also save in a 529 to take advantage of those tax benefits. So literally anyone can open a 529 account as long as they have a U.S. Resident and have a taxpayer ID number, social security number. They can open an account. Certainly can. So a lot of the 529 plans, most all of them are national plans, meaning they can be opened at any state. But it is always a good thing, and we do always advise you should check with your home state plan first before looking at other states' plans, because your home state may offer you some additional state tax benefits, such as a state tax deduction or a state tax credit. And so you definitely should check out your home state plan first for those extra state tax benefits. The federal benefits are uniform across the board, but those state tax benefits can be an extra benefit that you might be missing out on if you use another state's plan. But there are options in other states that might be more appealing to you based on your investment selection that you prefer, or just based on some fees that might be involved in the plan. So there are a lot of people who use plans not in their own state, but you should definitely check your own state first. So you do not have to use your 529 account for a traditional four-year college. You can use it for a 2-year degree, an 18-month program. They're extremely flexible. The key is it has to be at an accredited institution, and you can easily find that information on the U.S. Department of Education's website to see if that particular school is accredited. But it can be used for any higher education expense. Again, 2-year college, 4-year program, master's degree, professional graduate program. It can also be used for apprenticeship. So as long as it's an approved apprenticeship, you can also use your 529 account for apprenticeships. That was just recently changed, and we appreciate that change because there are a lot of doors opening for the trades, and there are a lot of apprenticeship programs that qualify for 529 as well. Absolutely not. Again, it could be a vocational technical school, and again, certain apprenticeship programs do qualify. So there are a lot of options, a lot of great flexibility with a 529 account. Sure. So there are, the majority of plans do not have a time limit. So there is no age of beneficiary where they age out and the funds have to be used. Most state plans, there's no age requirements. So the money can sit there. If, let's say, the money is there for a long time, let's say the beneficiary maybe perhaps, hasn't started their higher education journey yet, or they choose maybe not to go to a institution beyond a 12th grade and they choose to join the workforce instead. There are a lot of options with a 529 account, so you can change the beneficiary to a member of the family, and that list is quite extensive. So it goes all the way from first cousins to siblings to, again, other spouses, step siblings of those, parents, any of those, aunts, uncles, niece, nephews, they can all use that 529 account. We also find that sometimes the money will stay there because they'll leave it there for future grandchildren. So let's say that individual beneficiary doesn't use the money, it can stay there, and then the beneficiary could be changed again to their children, and then a grandchild perhaps could use the funds. So if in the event you cannot find anyone to use the 529, which does happen from time to time, but not often, you can withdraw the funds. It would be a non-qualified withdrawal, and then that would incur some tax penalties on that non-qualified withdrawal on the earnings portion.
And that wraps up this episode of BRN Weekly. Have a topic of interest, somebody you think we should talk to? Drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? We'll visit our website, and of course, all of our streaming partners. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, financial services, and government as we analyze all the news and events for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network. Available anytime, anywhere, and on any device.